Jay Do, thanks so much for coming on the Infinite Banking Radio podcast. How you doing, man?
Hey, man, I am good. Thank you for having me, Nolan. Good to see you.
Absolutely. So, man, let's just get into this. Obviously, guys, like I just mentioned earlier, this guy has an insane business model. The Banking Bros, he is one of the main leaders there. So, Jay Do, get us telling about your story, man. Who you are, kind of how you fell into this insane strategy on what you do with your clients and what you do, man.
Yeah, man. So about 8 years ago, me and my brother were broke, man. We were broke. We were doing other things. And somebody invited us into a presentation where we saw a live experience, 90 minutes run through of what the infinite banking concept was. Never heard of it, didn't know. The people who invited us were very confused as well. And we caught on. So my brother and I realized there are a few things about what we heard, and that was that insurance is guaranteed and the numbers always went up. We understood that. We didn't understand much else, but we knew we were in the right room with the right people to help us understand what was going on. So we got started, being a person who is a practitioner of privatized banking, IB, and cash flow banking, whatever you might know it as, was how we started. We were doing it first. And one of the significant things now, where I fast forward 8 years into it, about 5+ years of helping other people design their life and their income and their finances and their passive income and all that stuff around a foundational fundamental system, is actually helping them get out of debt. Most people are in some sort of financial situation they don't want to be in. That's how most Americans actually are. So that's one of the key things that we help people start on once they get going is, hey, let's utilize the insurance company's money, someone else's money, OPM, to actually get out of your debt. Your money's safe, compounding, growing, but let's cash flow someone else's dollars to get rid of them crazy loans you got out there. So that's one of the things that we're doing right now with a lot of people in the beginning stages. There's several people who are much more advanced than that, and that's what me and my brother are now doing, and we're exploring opportunities for investment and passive income. But we get a lot of people started just on the basic level. Hey, are you where you want to be financially? And the answer is often no. And the reason is we've been fed a bunch of false information that most of us have believed. And we're just out here trying to work harder and not actually put our money in a good place.
Yeah. Well, just give us your 30,000-foot view of infinite banking, or this infinite banking concept that Nelson Nash kind of discovered. What is infinite banking?
Infinite banking is the process of financing things. Is what it is. Now, that's crazy because in a 30,000-foot view, I'll be honest, man, I didn't know what that meant. I didn't even know what that sentence meant when I first heard this information. It's just the process of financing things. And it's something that Nelson said, as you mentioned, of course, Birmingham man, just like yourself. And he said, you actually have to finance everything you buy. You either pay someone else for the money you borrowed, or you give up what your money could have done by trading it for stuff. And that blew my mind when I finally was able to chew and swallow it. I chewed on it for 2 years, 3 years before I was able to swallow it. I was like, I don't get that. But that's what it really is all about. And most people get caught up too much actually in the product that they use or don't use for that process. But it really is about processing. And of course, Nelson Nash had the book, Becoming Your Own Banker, BYOB. The most important piece of this pie is you, the person, the banker, and not actually the product. It's really a process. And so we just use the most efficient tool. And that's what you and I know, spend a lot of time on and teaching people, is we teach them about the tool because we don't understand how to get to the process unless we understand the tool and how the tools we're currently using, whether that's your qualified plans, that's cash, in your mattress, or it's credit cards. Most people don't understand the process they're using now. So we do have to explain the product quite a bit.
Yeah, absolutely. I mean, and like you mentioned, infinite banking is a process. When I talk with clients, I say, 5% of this is product, 95% is behavior. It's how you act with your money. It's how you treat your money. Do you treat it with the same respect as your bank does? When you take money from an account, do you refill it with interest? Do you practice EVA, economic value add, things like that? I wanted to get your opinion on this. I've probably rewatched your webinar at least 3-4 times now, because of how impactful it has been for me, and just how easy that you break everything down. Can you kind of go, and one of my favorite parts of your presentation was when you started talking about compound interest, the illustration or the exercise of what a penny does over 30 days if it's doubled. Can you go in a little bit more detail and explain to our listeners how important not interrupting compound interest is? Because people get caught up and say, oh, why would I pay interest on my own money? Or I could get a higher rate of return over there, or whatever the normal objection is. Can you talk in some detail about how important and how paramount it is to not interrupt compound interest?
Yeah, so ladies and gentlemen, we got to go back to about 9th or 10th grade high school math class first. So think of your math class, think of your teacher. And I wasn't paying attention in there, but very much. But the first time someone posed that question to you, hey, what happens to a penny if it doubles every day for a month? And what we realize when we see that for the first time is, number one, we were way off in realizing how much money it was going to be, right? We did not realize how much money it was going to be. So depending on if you're going 30 days or 31 days here, we're at $5 million. $10 million is what a penny doubled every day for a month becomes. That's really powerful, and that shocked us. It shocked us so well that we never forgot that, even though we don't think about it much. And the reason we don't think about it much is because our money never grows like that. Our money is always interrupted, right? And so one of the things that we show in our presentation or ask people is, hey, do you have taxes? Do you have fees? And do you need to take withdrawals where you put your money? And everybody's like, yeah, of course. I'm like, yeah, me too. See, it's a me too thing. We're all stuck in a financial environment where taxes, fees, and withdrawals are going to be subjecting our dollars, and we are not able to actually compound. That's why we don't think about it. We never forget how big that penny got. We just can't actually duplicate it in our life until now. So we ask people all the time when we're starting them and we're letting them see our information. It's free. You can go watch it. If there were a place where you could compound your money uninterrupted without taxes, withdrawal issues, and fees, and it just kept getting bigger, would you want to know? And people are like, yeah. Like, what are you talking about? Like, what? Yeah. And I'm like, okay, so let's show you how this is actually possible. So it's such a huge turn on for people to help them understand exactly what you said. It's not about comparing it to an investment. It's just, what if you could put your money in a place? You put your money somewhere. Now it's either going in TD, B of A, or Dub F, right? It's going into TD Bank, Wells Fargo, or B of A, right?
I love it.
It's going somewhere, but what if you could just put it somewhere where it kept growing no matter what? And you could still, what's crazy, of course, is we have to now introduce them to the next step. We go from 9th grade math to senior math. Is, okay, now that it's in that safe place, you actually get a separate pool to spend, because we know that you still have stuff you want to buy, and you have bills, and you've got opportunities for investment. So you're still going to get a separate pool of money, but your dollars are going to keep getting bigger. So that's what we help people see. Don't think we're smart out there, ladies and gentlemen, or Nolan. Man, it took me and my brother 4 years to figure out how to break this down so even mom could understand it. We were like, man, this is golden, but we're trying to help regular people understand what's going on. So
yeah, well, again, you guys break it down to the simplest terms. I mean, for a guy like me who dropped out of college and started working for the city of whatever professional baseball team I was playing in that summer, I could understand the information that you were conveying. But let's go into a little more detail. Again, I wanted to talk more about your presentation, because again, guys, and I'll link this in the bio of this episode. It's so good. It is so good. When you guys start comparing a guaranteed interest rate versus a market interest rate, and we say, hey, we're going to earn let's just compare it. A 4% guarantee, nothing ever happens to it. Or you could earn 6% in the market, but there's some volatility. You might have 1 year of a total of 10 years where you have a 20% dip, and let's just see what happens. And you end up finding out that even if it's a smaller interest rate of guaranteed and knowing it's never going backward, you'll have more money. Can you speak a little bit more about going into a guaranteed interest rate versus any type of volatility in the market, and how much that can, again, burn the compound interest?
Ladies and gentlemen, so here's the question for you. It's not about where you store your money in the market, okay? That is a general term we're trying to help you understand. So I appreciate you bringing this up, Nolan. It's not about this market fund. It's not about this stock or anything like that, okay? So we're just making up numbers and we've thrown them on the screen for you. So here's the question. If you had a guaranteed growth rate on your dollars, whatever it is, but let's go ahead and pick 4. Me and Nolan have a reason why 4 is a pretty sexy number. So we'll get to that later in the presentation. So you guys can watch it. But let's just say it was 4, okay? And you are going to grow your money over the course of that time because you had your money in something that was guaranteed. But if you even had a larger number like 6, a larger growth like 6 over the course of the same amount of time, let's say a decade, but you did have a dip. We made up the dip. It's a significant dip of 20%. What's really crazy about that, if you just look at the math, my daughter is in 3rd grade, Nolan. She's in 3rd grade, and she can look to see where you come out over the course of your investment, your 10 years. And the 4% guaranteed is a bigger number than 6 with a dip at any point of 20%. So what's really crazy about that is over the course of 10 years, my daughter is drinking milk with her buddies at the lunch table, and all her buddies are getting 6% over the course of 10 years. 9 out of 10 years, 90% of the time, they're getting 6. And she's drinking milk, and they said, how's your thing doing? And she says, I'm getting 4. And they laugh at her, and they say, you stupid, you should do what we're doing. We're getting 6. Why are you only getting 4? Come on over. That's 9 out of the 10 times that they talk about it each and every year. But they have a dip. One time, 20%. We made it up. Who has more money? It's very simple math that a 3rd grader could see. So we're trying to help folks understand that guarantees, uninterrupted compounding interest is so powerful, but we get fooled by all of our buddies. There's too many of our buddies drinking milk. You know what I'm saying? And they're all around us, and they're talking to us, and they're saying things to us, and we're getting a little bit confused. And it just the math doesn't lie, right? The numbers, if the numbers are real and they always go up, it doesn't even matter what the numbers are. So
seriously, yeah. Well, and that's a great point. Again, a lot of people are out there. There's a lot of noise, as you know. A lot of financial entertainers have an opinion. Do this or do that. Put your money here. Don't do this. I wanted to get into one other idea because, again, it's such a it's the largest objection that I received, that I also, when I was first starting out, my biggest objection is, why would I go borrow my own money? Why would I charge myself an interest rate to borrow money? When you look at the, depending upon the carrier, depending upon some variables of that, but the insurance company is going to charge us interest when we borrow their money. Can you go into some detail as to why paying interest to the insurance company makes the most sense in the entire world?
Yes. So number one, I'm breaking things down for you on this podcast in a non-visual way, as you guys are listening or looking at our faces out there. Ladies and gentlemen, is, well, do the math. Do the math. See, I never did the math. I'm not saying that I'm smarter than you or I know something. I'm just saying I looked at the number and went, well, the number's bigger if I actually do it this way. That's really what's crazy. So I don't want to convince you, ladies and gentlemen, if you think that 10 is a bigger number than 5, then we're on the same page. We're on the same page because 10 is a bigger number than 5. So why don't we just do the math? That's all we're saying here. So it's a great question. So number one, I actually think it's a little bit misleading for us in our minds. It's not that anyone out there who's trying to help you understand infinite banking is telling you incorrectly, but ladies and gentlemen, when you borrow from your policy, cash value, when you take, I use the word borrow, I've used the word take, when you remove, when you want money from your policy, actually, it's not yours. Your money is still there. And that's why you get uninterrupted compounding interest. When you borrow from the insurance company and take your money out of the policy and grab cash value, we know that we use those words interchangeably, folks like Nolan and me, but actually it wasn't yours. The insurance company gave you a prepayment of all that death benefit they owe you. Mm-hmm. The death benefit is not yours. You gave them premium, and they gave you a much bigger pool of death benefit. Well, where did that come from? Not you. I mean, I'm gonna go back to third grade, not you. Yeah, I mean, I gave them $1 and they gave me 100 in death benefit. It didn't come from me, and they're giving you more and more and more of the equity of the total they owe you. They owe you money, that death benefit. So when you're borrowing cash value, first off, we like to people to be clear as we use these words interchangeably. I understand it can be confusing. The cash value wasn't your money. It was part of the money they owed you. So that's why you're getting uninterrupted compounding interest. And if you borrow against their future pool that they owe you, and your money continues to compound and grow, even if you pay them their money back, cash value back, become an honest banker with interest, you still come out on top. We can just do the math. So that's what's really crazy about it. There's about 50,000 different ways to say that. So Nolan may say it a little different than me, but that's really what's happening. And because it's true, it's always going to work out in your favor to actually pay the insurance company interest on the money that you borrow from them. It always works. So let's just do the math. So we try to do that in our presentation, and when we walk and talk through people this idea, because I mean, if the numbers always go up, then they don't matter. Then it doesn't matter. The numbers always go up in your favor. So you can go ahead and actually pay the insurance company on those borrowed dollars, and you still win. So
yeah. You know, I had a conversation with a client just actually about 3 days ago, and he's a real estate investor, and he comes and says, "Hey, I've got a couple ideas. I'm got 100,000 in cash value, and he's got a couple 100,000 in just a checking account at Bank of America, and he's got to go put money into this syndication." And he goes, "Where should I pull the money from? Should I pull it from this Bank of account or this cash value or this Bank of America account?" And I'm not joking, man. After watching your presentation and really seeing the numbers of the compound interest, and I understand the penny doubled is more of an exercise, but I said, dude, every time that you take money out of any account and you remove it or you withdraw it, you've just given up, you've killed the compound interest ability. And again, like you said, when we're in the day-to-day, it's difficult to kind of see that over time play out the way it does. But again, your presentation has just really rocked on how I underestimated or undervalued compound interest, if that kind of makes sense. Can you kind of go into one more thing as we close up here? Can you go into the tax implications of this? How are we able to keep this money inside of this policy? It grows uninterrupted. Even when we borrow it, it continues to work, but we also don't have to pay any taxes. How are we not able to tango with Uncle Sam when it comes to these properly engineered life insurance policies?
See, that's a great question. So many great quote unquote selling points about the infinite banking process and how it goes on. Ladies and gentlemen, we haven't even got to that. So let me ask you a question, Nolan, and you can respond on behalf of your listeners. So everybody, Nolan's going to be your mouthpiece on this one. Should you value, or do you like money better if it grows and Uncle Sam can't get to it?
Absolutely.
Okay, very good. All right. Remember, I like to break things down third grade, ladies and gentlemen. And third grade was the last time my parents spoke to me about money, so I didn't know anything, right?
Yeah.
So I asked third grade questions. Yeah, I like money better if Uncle Sam can't get to it, and he's not going to mess with it. Okay. So here it is, ladies and gentlemen. Let's go on a little bit of a history journey and a lesson here. All right, 110 years ago, 1913, the Fed came into play and they created the income tax. The income tax, it became a regular federal steady annual thing. There was not like income tax as we know it prior to that. There was taxes for wars because the government is out here spending like crazy. Mm-hmm. So, ladies and gentlemen, whole life insurance, the vehicle that we're going to be able to use from certain companies for the process of infinite banking is older than the Fed. It's older than the IRS. It's older than income tax. So here's a very simple way to break it down. Nolan, if you would please answer on behalf of everybody. Now, God forbid you crash your vehicle. You've got insurance on your car, yes?
I do.
Okay, great. You crash your vehicle. God forbid, we don't want that to happen. Tree falls on your car, somebody T-bones you, and the insurance company must pay for that loss. You have insurance. Now, when they hand you that check and you've had a loss, they give you money, is it taxable income?
Well, I didn't gain anything.
Correct. Ladies and gentlemen, insurance is not income. It is not something that you report or write down. That is a loss that got covered by someone else. That's how it works. It's older than the tax code. It's not income. Ladies and gentlemen, the growth inside your policy, the cash value, and the death benefit at the outset, at the core, are not income. So it's not taxable. When you borrow against the future value of a loss, you have to take. Ladies and gentlemen, the bad news on this podcast is you're going to die. You are going to die. There's going to be a loss. The insurance company has to pay for it, and it's not income. If you borrow against it using cash value from the insurance company, it's not taxable. It's not income. Ladies and gentlemen, would you value money more if you could use it and abuse it and invest it and spend it and give it to me so we can go to Vegas out here with Nolan and it's not taxable? I think you might want to consider how to use this process in your life.
Man, that's awesome. And I 100% agree. And the way you broke that down is it's about as great as I've heard it. But again, man, I appreciate you coming on and taking a few minutes of your time. I know that you probably got about 18 calls when we get off the phone here because you guys are just rocking and rolling, man. So any other things or thoughts before we get out of here, man?
Yeah, ladies and gentlemen, I want you guys to understand that there are so few actual people out there like Nolan who are giving you this information in a clear, concise way, but doing it properly, utilizing the right product. It's so interesting because we're out here trying to tell you all these great things about the process and your thinking, but if you actually use the wrong product, which 9 out of 10 people on the TikToks and the Instagrams and the YouTubes are actually telling you, it's not going to work this way. Not all insurance products, not all insurance policies, not all insurance companies are the same. We're going to go for the oldest, dorkiest, ordinariest stuff out there because it's the guaranteed stuff. So don't get caught up in thinking you can go to your brother-in-law and get this started. So stick with my man Sanburn over here and have him help you get started so it doesn't mess you up. It's a guaranteed contract and the insurance company takes all the risk. So you just want it to be plain and simple and guaranteed for the rest of your whole life.
Awesome, man. Well, Jay, I appreciate you, brother. Thanks for coming on, man. And again, I'm going to have all his information in the bottom of this bio. But again, we're going to be doing a lot of things going into this year and into the future. So again, JD, can't wait to partner up and keep this party rocking, man.
10-4, man. Appreciate you having me. Thank you.
Okay. Thanks, JD. See you, man.